You can say we are waiting for a minute to people to join and then you can start in 30 seconds, 40 seconds.
Why am I not able to see the video? Okay. Good morning, everyone. We will be starting in a minute. Great. Yeah. So good morning, everyone. I am Imran. First of all, thank you everyone for joining in here today morning. I hope you all are well. And thanks a lot to the CCI France team to put this together. If I may propose, the way we are going to structure the webinar today is that we will be spending 5 minutes on an introduction about the next time, about the genesis of corporate tax. Then I will hand it over to my colleague Nishit, who's a partner with Next Time SKP and comes with the expertise of corporate tax and transfer pricing. The presentation would last about 40-45 minutes. And the last 10 to 15 minutes, we will deal with the question and answers from you. So having that said, allow me to introduce Next Time to you. Next Time as an organization, we have a legacy of about 60 years. Currently, we're present in around 7 countries across the world. That is the geographic footprint. These countries include United States, Canada, Poland. In UAE, there are 3 offices in UAE, then 5 offices in India. And lastly, we have our presence in Japan and Hong Kong. With a team size of about 1,600 people globally, we have a dedicated team of 200 people on the tax side. The philosophy of Next Time in terms of partnering with clients is that we serve our clients throughout their life cycle, which includes right from conceptualization to enabling them do the business across the life cycle. And when I say that, we mean that all the pre-investment advisory, setting up legal entities, taking care of all the finance and tax compliances, secretarial compliances, so on and so forth. And for the larger companies, or once the business has attained a certain size, we jump into the areas of transformation, digitalization, efficiency improvements, assisting on mergers and acquisitions, so on and so forth. Next Time works with more than 1,000 client groups across the world, which comes from more than 50 countries. More than 100 plus of our clients are from the Fortune 500 category. We also work with a lot of family-owned organizations, private equities, small and medium enterprises across industry lines. Having said that, I would like to draw your attention to the elephant in the room. So UAE's strategic move to adhere to global standards and align with OECD's global minimum tax proposal under Pillar 2 has led to the implementation of corporate law. We've all been waiting for this regulation for quite a while. It's finally out with most of the details. So corporate tax will come into effect from years which are beginning from June 1, 2023 or afterwards. So having said that, businesses in UAE will need to navigate landscape of this new tax with care. While the law is largely based on the public consultation paper, which came out in April 2022, businesses based in UAE would need to be geared up to adapt to these new changes. The companies need to evaluate the applicability of the provisions, align the structures to make it tax efficient, and also align policies for interrelated party transactions from a transfer pricing point of view. With that in mind, we again welcome you all for this insightful webinar, which will shed light on several aspects of the UAE corporate tax and transfer pricing. Having said that, I will hand it over to my colleague, Nishit, who will take us through this presentation, who will also be joined by another colleague of mine, Lokesh Gupta, who's an expert on transfer pricing. Nishit, over to you.
Thank you, Imran, and thank you everyone for joining today. So I would, in next 30 minutes or so, will take you through the corporate tax how it has evolved in UAE, what are certain critical provisions under the law which may have impact on businesses and may require some bit of work on the part of companies to ensure that they are compliant and tax efficient at the same time. So from a journey perspective, as we all know that on 31st January 2022, first FAQs were issued, which said that corporate tax is going to be introduced in UAE at 9%. Then shortly within 3 months on 28th of April 2022, a public consultation document was issued which gave a brief or rather a good overview on the impending law which was to be released. Post the consultation document, a lot of suggestions were made to the FTA, and few of them are also considered and implemented in the final law. One of the big change from the consultation document to the final law is on taxation of free zone companies. Earlier consultation document had a big impact on free zone companies doing business with mainland companies. Now that has been slightly mellowed down, and we will see how the regulation is currently in the subsequent slide. The law is applicable for any financial year beginning on or after 1st of June 2023. So if you are following a July to June financial year, then for you, the first tax period will start from 1st of July 2023. And if you are following calendar year, then your first tax period would start from 1st of January 2024. And your first compliances in terms of filing of tax return and paying of taxes would come within 9 months from end of your financial year. So if your financial year is ending on 31st of December 2024, then the tax return and the taxes have to be paid on or before 30th September 2025. Now let's look at who is covered in the scope of taxation. So the law covers any juridical person incorporated in UAE, including free zone entities. So any companies, LLPs, LLCs, unincorporated JVs set up, incorporated in UAE, including any entities set up in any of the free zones, are covered within the scope of taxations or considered as taxable person as per the UAE corporate tax law. A natural person, so like an individual who is carrying on business in UAE, is also covered. They will specify what kind of business activity would be covered for corporate tax. An individual's income like salaries, remuneration, bonuses, capital gains, interest income, all of that is not covered under corporate tax, and that will continue to remain tax-free for individuals. There are unincorporated partnerships concept in UAE. Those unincorporated partnerships would be liable to be taxed in the hands of the partners and not at a partnership level. Again, there an option has been provided whereby partnership can make an application to the FTA and decide to be taxed at a entity level, that is at the partnership level, rather than being taxed in the hands of each of the partner. Foreign fiscally transferred partnerships are also covered. Family foundations are also covered under the tax net unless they exercise the option to be taxed at an individual level. And then there are certain conditions as to when they can elect to be taxed at an individual level. The last one is very important for UAE companies or UAE residents who are having ownership in companies outside of UAE. In these cases, if those companies are considered to have a place of effective management in UAE, those foreign companies would be liable to tax in UAE if their POEM is in UAE. POEM has very broadly defined to say that wherever key strategic business decisions are taken by a company would be considered as place of effective management of a company. So to give you an example, say a UAE resident has a BVI company and that company is doing trading business, but that company hardly has any employees. The UAE resident is the director of that BVI company. The board meetings are either conducted virtually while the director is sitting in UAE. The UAE resident is giving all the directions and the decisions to the BVI company. Then in all likelihood, that BVI company may be considered as having a POEM, that is place of effective management in UAE, and the profits of that BVI company would be liable to tax in UAE. If you look at global context, many countries have POEM regulations. There are few countries where there is a threshold provided that if your turnover or sales in a particular jurisdiction crosses a particular limit, then only POEM regulations are applicable. Currently, the UAE law does not provide for any threshold, and hence POEM would be applicable even if there is a single dollar of revenue in the offshore company. For non-residents who are doing business with UAE, the government has mentioned that any foreign company would be considered under the scope of tax if they have a permanent establishment in UAE. Permanent establishment would mean having a branch office, having a factory, having a site, or any other fixed place through which the person is carrying on the business, or having an dependent agent in UAE through which they are concluding contracts or negotiating key terms of the contract. Another big definition under the UAE corporate tax law was on state sourced income. State sourced income has been widely defined to include any income earned from contracts in UAE, from resident in UAE, from assets located in UAE, activities performed in UAE, or economic rights used in UAE. So to give you an example, there could be a situation that there is a transaction between two non-resident and it could still be considered as a UAE sourced income. So say for example, a US resident mortgage shares of a UAE company and avails a loan in US, then that transactions, whatever income the other person is earning out of this mortgage transaction can be considered as UAE sourced income as it involves an asset from UAE. So the definition is very wide. If we currently read the law, it says that UAE sourced income would be liable to tax in the hands of non-resident. So technically any sale of goods or any activity you conduct in UAE may get liable to tax in UAE. However, in the FAQ released by the MOF along with the law, they say that UAE sourced income would not be liable to tax and there is no withholding tax on UAE sourced income. So to that extent, there may be additional clarity required as to how, whether the FAQ can be read into the law. As a general principle, the law always prevails over the FAQ. So some clarification on the law by way of notification would be required to make it clear that UAE sourced income is not liable to tax in UAE. Otherwise, if you are coming or doing business in UAE from a non-tax treaty country like US, Australia, Kuwait, Qatar, Iran, where UAE does not have a tax treaty, there could be a potential risk for a non-resident who is earning UAE sourced income, and there could be certain tax implication for that person in UAE. They have given certain categories of people who would be kind of considered as exempt from taxation. Obviously, those are government or government control entities, any person engaged in extractive business and non-extractive natural resource business. They have kind of given few conditions as to they should be taxed under relevant emirate legislations and other few conditions, which if satisfied, they would not be liable to corporate tax. Qualifying public benefit entities and qualifying investment funds subject to certain conditions would be exempt from corporate tax. Public pension funds, social security funds, regulated funds, a jurisdictional person incorporated, which is completely owned by government, is also someone who would be exempted from corporate tax. So only thing for companies which are engaged in extractive business or non-extractive business which are paying emirate level tax. If for some reason they are not able to satisfy the conditions provided under the law, then they can be taxed doubly, because they may pay emirate level tax plus they will have to pay corporate tax. No set off would be available of these taxes. What is the tax rate? So now the tax rate is 9%. So for all mainland companies, if I have to put it, first 375,000 AED worth of profits would not be liable to any tax. Anything earned in excess of 375,000 dirhams would be liable to tax at the rate of 9%. Currently, a resident company in UAE is not required to withhold any taxes on UAE sourced income when they are making payments to the foreign companies or foreign residents. While there is a 0% withholding tax rate provided under the law, that would mean that there is a room kept open to increase this rate in future, and there could be certain compliances in future which may come about in respect of the withholding tax. The final law also spoke about having a small business relief. Currently, they have not provided what are going to be the revenue threshold to claim a small business relief, but that is expected shortly, and most likely this small business can opt for this relief, and they may be relieved of certain compliances under the UAE corporate tax law. Now coming to free zone person. So this is very important, and like I mentioned earlier, a huge change from what was there in the draft law to the final law. Under the draft law, it was provided that if you even do a single dollar transactions or a single AED transaction with a mainland company, your entire exemption goes away and you will be liable to pay corporate tax on your entire income. Now that has changed. Now a free zone person or a free zone entity first has to qualify as a free zone person. And there are 4 key conditions in order to qualify as a free zone person. One is the free zone company has to maintain adequate substance in UAE. The substance test is not currently linked to the ESR compliances which you are already or you may be already doing. But my view is that if you are compliant from an ESR perspective and you are meeting substance under ESR regulation, by and large, it can be said that you are meeting substance regulation under the corporate tax law as well. However, if you have, for any reason, the ESR regulation was not applicable to you, then now you will have to look at your substance from a corporate tax law perspective, especially if you are in a free zone. Second condition is that it derives qualifying income. What is qualifying income? That they have said that they will come out with a definition of qualifying income, and that is kind of widely awaited by all the free zone companies, that what this qualifying income definition is going to be. But if we go by the public consultation document, and this is just a thought which came out of the public consultation document, and we'll have to wait for the final qualifying income definition. Public consultation document in a way exempted income earned by free zone from export of services or export of goods or for transactions within the free zone. So if you are having export income, that is income you are earning from outside of UAE, or you are earning income from free zone or different free zones, then by and large, in my view, it may be considered as qualifying income. any income you are earning from a mainland company, that probably, in my view, can be considered as not qualifying income. One area or one thought which came and which is open and we are awaiting clarification is whether if your customers are from UAE or the services which you are rendering is utilized in UAE, but your revenue is from outside of UAE, whether that would be considered as a UAE sourced income or not, or whether it would be considered as a qualifying income or not, is something which we will have to look at once the definition comes out. But that is something very important and everybody is kind of waiting for that. Third condition is that you should have not elected to be subjected to normal corporate tax provisions. So I have a case study in the end of the presentation where we will kind of discuss that when a corporate tax exemption or a free zone exemption can be given up, in what kind of situation, and where you may want to be governed by the local provisions rather than continue to avail 0% tax benefit. One of the key criteria is qualifying income, whatever you earn, would be liable to tax at 0%. All the balance income, that is, which is not qualifying income, would be liable to tax at 9%. And here, based on the reading of the law, you will not get the benefit of 375,000 AED, which we discussed in the previous slide, because you are already getting benefit of the qualifying income. Irrespective of your computation, whether you are falling under 0% tax or there is income tax or there is no income tax, you will be obliged to obtain a tax identification number in UAE and file tax returns and transfer pricing documentation as may be required. One of the fourth and the most critical condition to continue with the free zone benefit is that you need to be in compliance with the transfer pricing regulation. So even if, say, you are making a management fee payment to your headquarter company outside of UAE or your parent company outside of UAE, still you will have to ensure it is at arm's length. That is how you would have dealt with in a normal third-party transaction scenario. Very important to claim the benefit of 0% tax rate for a free zone company. As we all know that under the OECD program, there is a corporate global minimum tax of 15%, which has been prescribed for large multinational companies, where the group level consolidated turnover exceeds 750 million euro. In those cases, if you are sitting in a free zone, you may end up paying 15% tax under the global minimum tax rules. UAE, under its FAQ, has provided that they will come out with separate set of regulations for free zone companies which are covered under pillar 2, that is the global minimum tax. Also, if you are in mainland and falling part of that 750 million euro group, still you may be liable to 15% tax, because they are going to prescribe a new tax rate for those kind of companies. And they are waiting for clarity as to how it is going to evolve globally, and then probably there could be a 15% tax there as well. Then how to determine your taxable income? Currently, they are going to specify that which all entities would be compulsorily required to get their financials audited. But by and large, if you are in a free zone and the regulator requires you to get your accounts audited, or for good governance, you are getting your accounts audited, then you can start with that accounting profit. And there are various additions, deletions you need to make from the computation and come with a taxable income and then apply the tax. We'll discuss on some of the deductions which currently are kind of very critical for companies to evaluate, see whether they want to restructure any of their transactions to ensure that there is no disallowance of expenditure to them. So if you are a highly leveraged company, there is a rule on interest deduction, which says that if your net interest to be paid is more than 30% of your EBITDA, then only a deduction up to 30% of your EBITDA would be allowed. Any excess interest paid would have to be carried forward for subsequent years. And every year you have to test this 30% condition and allow that expenditure. The maximum carry forward period is of 10 years. They may come out with a safe harbor where if your interest amount in absolute terms is say 1 million dirhams or whatever that number they may prescribe, then these provisions may not apply. But that number is still not out yet and we'll have to wait for that. Second and most critical is business promotion expenditure for companies. Straight away, 50% of the expense on entertaining customers, suppliers, and business partners would be disallowed. Any meals, accommodation, transportation, admission fees, etc., which you pay on their behalf or in entertaining your customers or suppliers or vendors would not be allowed as a deduction. So this is very critical. Companies need to look at what are the expenditures sitting, whether they can do anything about it. Then all your recoverable VAT, taxes, withdrawal from businesses like dividends, share of profit, etc., obviously would not be allowed as a deduction. Any donation, fines, penalties paid would not be allowed as a deduction. So you are filing a VAT return late and paying a penalty on VAT return, that penalty amount would not be allowed as a deduction. Expenditure incurred for earning exempt income. This is very critical because your profit and loss account would have income which would be liable to tax and income which is not liable to tax. If you have income which is not liable to tax, then you will have to bifurcate your expenditure to determine what expenditure is incurred for earning exempt income, and that part of the expenditure would have to be disallowed. So this is an exercise which you will have to start looking at right now. Also see whether you want to move this exempt income from your company to your promoter's hand so that you don't have to get into this entire accounting aspect of calculating the expenditure on exempt income. Any losses which are not connected to your business also would not be allowed. Any interest on loan, if you are taking that loan to repay your shareholders in any form and shape, either by way of distribution of dividend, capital redemption, repurchase, or any of that sort. Tax losses. So if you incur a tax loss in a particular year, that loss would be allowed to be carried forward for an indefinite period and set off in subsequent year. But only 75% of the taxable income would be allowed to be set off. So in essence, every year on 25% of your income, you will have to pay a tax. So for example, if you have a carried forward loss of say 5 million AED, in the next year, you have 1 million AED as your profit. Then only, even though you have a 5 million AED loss, you will only be allowed to set off 750,000 AED, and on balance 25,000 or sorry, 250,000 AED, you will have to pay taxes in that year. In cases of certain losses, no carry forward would be allowed. Obviously, any losses which you incur prior to the corporate tax regime would not be allowed. Any losses you incur before you elect to be governed by the city regime, especially for a free zone company. Any loss incurred from activities asset generating exempt income. So while this is very clear for the losses, what is not clear currently is that what happens to expenditure or income which you earn because of a transaction which was carried out before a city regime. So say for example, if you had made some sales or services today when the corporate tax law is not applicable, and next year you realize that that money is not recoverable and you want to write it off as a bad debt, then whether that bad debt would be allowed as a deduction in subsequent year because it pertains to an income which was not offered to tax is something we'll have to figure out how to kind of manage that. Also, similarly, there could be write backs which could be taxable for expenses which were incurred prior to the city regime. So all these are open points which probably in due course we may get some clarity, or as businesses at least we can start preparing and timing this in the right way so that we don't have an additional tax outgo because of this kind of situations. Losses can be carried forward indefinitely, subject to couple of conditions if there is a change in ownership. So if your 50% of the shareholding is maintained, then you can continue to carry forward your losses and set it off in the subsequent years. Or if more than 50% of the loss, 50% or more of the shareholding has changed, then there are certain conditions under which you will be able to claim the loss. That is, you should be continuing the same business using the same asset. There should not be a significant change in the core business activity. Within a group, there is a concept of transfer of tax losses as well, whereby one company within the group where there is a common ownership of 75% can transfer the loss to another entity, and that entity can up to 75% claim the loss. Only thing is that once I transfer the loss, in the example shown on the screen, there is an loss of 250 which is transferred, and company B, like I mentioned, would be able to take a set off of only 75%. So there would remain a balance loss of 25. So whether that balance loss would be carried forward by company B, or it has to give it back to company A, or in subsequent year, if company A has profits, whether this 25 again can be transferred. Most likely it should be. There are certain incomes where exemption has been provided. So any dividend income earned from domestic companies would be exempt. Dividend or capital gains earned from foreign companies would be exempt, subject to participation exemption. So say for example, a UAE company has a subsidiary in KSA, Qatar, and any dividend or capital gains it is earning from that companies would be exempt only if it satisfied certain conditions known as participation exemption condition, which we are discussing in the subsequent slide. Income earned by a non-resident from operating or leasing aircraft or ships would not be liable to tax if similar treatment is provided to UAE companies in that foreign jurisdiction. Foreign branch of a UAE company would, from a residency perspective, be considered as resident of UAE, and the income has to be clubbed with the UAE entity. However, there from a tax perspective, two options have been provided. One is that you can include the income of the foreign branch in the income of the UAE entity and offer it to tax and claim credit of the taxes paid in that foreign country from the tax payable in UAE. Obviously, the taxes would be restricted to the UAE taxes payable, and there cannot be a refund out of the taxes paid in a foreign country. Or alternative is that you can claim a direct exemption, that you don't include the profits and you don't take the credit of the taxes paid in the foreign jurisdiction. But this option is available only if the branch is subject to a tax of 9% in the foreign jurisdiction. So this means that if you have a branch in a jurisdiction where the corporate tax rate is 0%, then you will have to compulsorily include the profit of that branch in your computation and pay tax on that. So having a branch may be more disadvantageous than having a subsidiary in a foreign jurisdiction if the tax payable in that foreign jurisdiction is lower than 0%, or there are issues in terms of getting the entire foreign tax credit in UAE. Participation exemption. So a UAE company having subsidiaries in other countries would have to satisfy certain condition in order to claim benefit of capital gains and dividend income. So if you are, one of the conditions that you should be owning more than 5% of the shares or interest in the capital of that company or the LLC. That country, that companies should be taxed at minimum corporate tax of 9%. Either you are holding the shares for 12 months or there is an intention to hold the shares for 12 months. Another important conditions or anti-avoidance condition is that not more than 50% of direct and indirect assets of the participation consist of ownership interests, which otherwise would not have qualified for exemption if held directly by the taxable person. So what this means is that if you are a UAE company you have another holding company, say for that matter in BVI, and that BVI company is holding, sorry, you have a company in Singapore, and that Singapore company is holding 5 subsidiaries in BVI, then technically this exemption would not be available to you, because while Singapore has a corporate tax rate of 9% and you are holding it for more than 12 months, but all your step down holdings in BVI, the tax rate is 0%. So by interposing a Singapore company, you can not claim participation exemption if the ultimate companies which are in the final jurisdictions are not complying with this condition. Or say you have a 100% subsidiary in Singapore, and through that you are holding 2%, 3%, 4% stake in different countries. Then at a Singapore level from which you will receive dividend, you may be complying with all the conditions, but all your step down company, at least 50% of your company, if they are not satisfying the condition of 5% holding, then also this exemption would not be available to you. Again, for a foreign company holding shares of a UAE company, capital gains would be considered as a UAE sourced income. So like I mentioned in the FAQ, it is mentioned that that would not be liable to tax, but if you read the law, it could be liable to tax. So we are awaiting clarification on this aspect. Another important thing is tax group. If you have multiple entities in UAE, you can decide for them to be treated as a single entity, do a single compliance. However, the key point here is that you need a local holding company to form a tax group, which kind of results in a lot of limitations for foreign companies having multiple subsidiaries in UAE. There are certain provisions on group relief where if you transfer assets within group where the common ownership is 75% or more, then technically the transaction can be done at a book value. There would not be any tax implication unless you sell the asset outside the group within 2 years' time. Similarly, there are reliefs for amalgamation, demergers, and other kind of corporate reorganization, where if you don't transfer it to a third party within 2 years, you will be able to claim a relief on the same. Then there are general anti-abuse provisions introduced under the law. So any transaction you do today would have to meet a commercial test. You cannot go ahead and do any restructuring without considering this GAR provisions, which says that any transaction can be disregarded if it is only done with the intention to save taxes. So all the restructuring you carry out would have to be carefully planned and would have to be seen that whether it falls within the GAR provisions, and if not, then you can go ahead and take ahead the transaction. With this, I end the corporate tax bit of it. I will hand it over to Lokesh for transfer pricing, and then there are a couple of case studies. Probably if time permitting, we can go through them quickly. Thank you, everyone.
Thank you, Nishit. That was very insightful. Thank you, everyone, for joining us. Thank you, FBC, for having me here. Yeah, so I think Nishit broadly touched upon the importance of transfer pricing related provisions, and I'm sure by now, anyone who has followed the law or at least the relevant announcements, they would agree that transfer pricing as a condition has been introduced for some of the significant provisions within the law, whether it is for claiming 0% corporate tax or for a compliance requirement. So on both front, I feel that transfer pricing will be an important area for businesses to look at while they plan their tax related planning as well as the compliance measure. So what does essentially transfer pricing mean? Because this is something which is very new for the region, while tax is also new, but this is slightly niche and not every company or not every person might have heard the concept before. So as a concept, basically, transfer pricing means or seeks to analyze those transactions which occur between the related persons. So essentially, if there are two related parties dealing with each other, they could potentially influence the price in a manner to save taxes in a particular jurisdiction. Meaning, let's say if the corporate tax rate at UAE is nil and overseas the corporate tax rate is 15%. Overseas, when I mean, let's say a headquarter in USA or headquarter in France, in our example, then the group would want to park as much profit in UAE because the UAE corporate tax rates are much lower. So that is how typically related party transactions are, uh, you know, basically implemented in order to get tax efficiency, and which is what the tax authorities are looking to, keep a check on to ensure that the companies do not take unfair advantage of the different tax regimes between the two trading partners. In our case, France and UAE, I'm sorry. So what is an arm's length principle? It's an established principle by now because essentially, the base literature from where the UAE has drafted the regulation, which is OECD related regulation, has a lot of literature around what is transfer pricing and what are the key concepts. So arm's length price or arm's length principle essentially means if instead of having a same transaction with a related person, if you were to have a transaction with the unrelated person, what would have been the price? Right? So you test the arm's length nature of a transaction on the basis of how the transaction would occur in an independent third party scenario. So essentially any arrangement between related parties and connected persons to comply with the OECD transfer pricing guidelines. Apart from at the having an implication at the transaction level, the law is also likely to have some implication on the compliance side. So which means that going forward, if you have a related party transaction, then the company is required to have a transfer pricing related policy in place, and they are also required to prepare a transfer pricing documentation. So documentation requirements are largely aligned to the global standards, which are basically 3-tier documentation requirement. Every company would have to have at a global level, country by country reporting. Then a company is required to have a global master file. And then at the local level, they are supposed to require or supposed to prepare a local file as well. The form and format for local file is largely aligned with the OECD guidelines at this stage, but there could be more announcements around how the disclosure, etc., will happen, which is likely to happen at the time of filing of the income tax return. This is on the concept of arm's length principle and the documentation. And to get into the nitty-gritty, basically, there are 5 defined methods in order to determine what is a arm's length price. And these 5 methods are, by and large relevant to all the regimes where the transfer pricing has is prevalent. And beyond the 5 method, typically, most developing countries or developed countries also have, given a flexibility to adopt any other method. And the method itself is called as any other method. So typically how the arm's length principle is applied is basically, arm's length range is calculated using a particular method, any of the 5 method or the 6th method. And as long as the results of the tested party or related party transactions are within that arm's length range, then the transaction is said to be complying with the arm's length principle. So what is the range? That has as of now not been prescribed, but globally, if you follow the OECD guidelines, the range is interquartile range, which is 25th percentile to 75th percentile. In our experience, different jurisdictions have come out with different range. For example, Africa, some of the countries have 35th to 60th percentile. US follows a full range. European countries follow an interquartile range, etc. So it will be interesting to see what kind of position UAE adopts in order to prescribe a range, an arm's length range. As I mentioned, at the compliance level, the UAE companies would also have to prepare and furnish a disclosure form. The form and format of the disclosure form has not yet been prescribed, but I think closer to the compliance rate, it can be anticipated. But going by the practical experiences in the other jurisdiction, wherever disclosure form related compliance are there, typically it requires companies to report all name and address, etc., of the related party, transaction values, and also what kind of method has been adopted to justify the arm's length test. Interestingly, the law which was published has given a relief, or seeks to provide a relief of the corresponding adjustment. So meaning, if a company in UAE suffers any transfer pricing related adjustment for the transaction which has happened with the French headquarter, then the French headquarter will get a corresponding adjustment. This is slightly interesting and beneficial to the taxpayers, because typically, given the background of the transfer pricing related provisions which are anti-avoidance, similar corresponding adjustments are not provided in all the transfer pricing related regimes that we spoke about. So yeah, this is something which is very different and unique, but a good thing for a taxpayer, that if you suffer a transfer pricing addition here, your counterparty could get a corresponding relief. So apart from transfer pricing related provisions, I think the arm's length principle also finds a mention in one separate article, and that article is on connected person. So you heard Nishit when he said that as of now, in terms of covered persons, the individuals have not been covered. So which means that individual or natural persons would continue to enjoy exemption from the corporate tax, which is going to be rolled out. However, what it could also mean is that those firms or those businesses which have individual or natural persons as owner, they tend to sometimes take advantage of tax being not there, or tax natural persons being exempt from corporate tax. So therefore, what basically this article seeks to cover is any payment that is made to a natural person who falls in the definition of connected person. That payment would have to meet the arm's length standard. For example, you have a company in UAE which is owned by an individual. He owns, let's say, more than 50% ownership right or voting right. Then that individual becomes a connected person. Now, if that individual draws any salary or any other form of remuneration from the company, then that salary or remuneration has to meet the arm's length standard. So broadly, to tell you who can qualify as a connected person, it can be an owner, which I said, on the basis of control or voting rights. It can be a director, or it can be a related party of either the owner or the director. So idea basically is to ensure that those transactions which owners are doing with their own company, they are supposed to meet the arm's length standard in order to ensure that the tax base of the company is not manipulated. I think those are the two critical items from a transfer pricing standpoint. I think Nishit wanted to cover a couple of case studies, so I'll hand it over to Nishit.
So being conscious of the time, let me skip this on the administration part, because we have broadly discussed all of this earlier. And from a way forward perspective, yes, all companies should do a corporate tax and transfer pricing impact assessment, relook at holding structures, capital structures because of the interest deductions, the expenditure, review the transfer pricing policy, and be prepared for the compliance and documentation which would follow when the law is in place. Obviously, a lot of things would start rolling from 1st of January, because most of the companies have financial year starting from 1st of January. But you need to factor in the preparation time. in terms of making changes to your accounting aspects, to do a restructuring transaction, the time authorities would take to turn around to do any restructuring transaction. And hence, while the law will evolve over a period of time, but it should not stop you in terms of taking steps. So just to give you a very broad level example for a mainland company, typically your profit and loss would look like, say you have a sales of 12,580 in millions. You have all your expenditure, and that's how you derive your accounting net profit. You start with your accounting net profit, then you disallow all your expenditure, which is not allowed, come to total disallowances, and then come to a taxable income. And that's how you calculate the tax. So this is how your typical tax computation would need. There could be multiple disallowances, allowances, which you'll have to factor. And if you are not able to control those disallowances or take care of those disallowances now, your effective tax rate may go higher than 9%, because your taxable income could be different than your accounting net profit. Like I mentioned, if you look at free zone companies, if majority of your income is going to be a non-qualified income, then it may be worthwhile for you to explore whether giving up the exemption makes sense for you or not. Because in the example which I have presented, if you have 500,000 AED worth of income, and out of that, if majority is out of free zone, so say here in this example, 500,000 is from mainland and 50,000 is from qualifying income, then under the free zone situation, since you don't get the benefit of 375,000 AED, you may end up paying tax equivalent to 45,000 AED. Whereas if you give up the exemption, then you will be able to claim 375,000 exemption, which is available, and your tax bill can go down to 15,750. So don't assume that you are in a free zone, then the other regime may not be kind of helpful. Obviously, it may require analysis in terms of type of your income you are earning, and basis that you may have to take a decision. So with this kind of, we like to end our session and kind of hand it over to Imran.
So thank you everyone for staying with us. We have some questions which we have received. We will try to address maximum questions in the sessions, and the questions we will not be able to take. We will reach out to you separately with a response. We are also running a couple of polls right now on the webinar to get your feedback and inputs. So if you can please have a look, we will appreciate your maximum response. And with that, we will proceed to answering some of the questions that you have raised. So Nishit, over to you back.
I'm just waiting for the poll to get over. And in the meantime, I can go through the questions. So first question is on, currently India has a DTA with UAE and the business income is taxable in India only. If Indian supplier earns income from a UAE customer, how is it taxed? So like I mentioned, that the source rule currently are slightly not clear and we are awaiting clarification. But if we go by the FAQ, then technically that income should not be liable to tax in UAE. Then another question is, if company A paid or received money from a customer or supplier related to company X, is there any impact on CEIT and TP? So if company A and company X are related party, both corporate tax as well as transfer pricing would have an impact and would have to be looked at. Then the next question is, what are the permissible deductions for a mainland company? So what they have said is that you have to prepare your computation or financials as per generally accepted accounting principle in UAE. So whatever is the accepted accounting norm like an IFRS, all the deductions which are allowed under the same would have to be allowed. There are certain adjustments on the how to adjust the forex gains, loss, unrealized gain loss, the deduction which needs to be disallowed. All of that needs to be kind of taken care of while doing this. For benchmarking, should we select local comparables or can select the comparables from different jurisdiction? Does UAE law provide clarity? So it would depend on which company is the tested party in your transaction and whether the comparables are available in that particular jurisdiction. If not, then you will have to look at similar or more fit kind of comparables from other region as well. The UAE law is mainly driven by OECD, and hence these are the some of the principles or aspect which OECD follows, and we'll have to go by that. We are a financial service company based in DIFC. We deal with mainland but also have a significant qualified income. At the moment, we are not required to get an audit done for DIFC purposes, would be required for get an audit done for corporate tax purposes.
Then second one. After the second, you can take this first one.
So the UAE law is going to prescribe specified entities where audit is going to be compulsory. So if currently there is no audit which is required and you are even after the law is published, no audit requirement is there on your company, then you can continue with not getting your accounts audited, but your financial statement will undergo a lot of change as you will have to bifurcate your expenditure also, which are for your qualified income as well as your not qualified income. Okay, so we will quickly run. I'm getting to know from the organizer that one more poll needs to be run, and then we can take one last question and probably then close the webinar. So one question is, does transfer pricing requirement apply for transactions between two qualified free zone person? Does it also apply for transaction between free zone company with offshore entities? So yes, there is no bar on domestic transfer pricing under the UAE corporate tax law. So if you are falling within the definition of related party, answer is yes, that transfer pricing would apply.
Okay, thank you everyone. We hope that you found the session useful and insightful. Feel free to reach out to us if you have any queries. We will be happy to get in touch with you and provide you a more customized overview and solutions and related to corporate tax and transfer pricing. Thank you everyone for joining us today and have a great day ahead. Thank you. Bye-bye.